don't get financial advice or credit advice from people that aren't already rich and wealthy, that means you need to go up higher, higher, and up your standards. Okay? There are people living in trailer parks and dirt roads on YouTube with thousands of even fake views and giving out false advice regarding credit. Now, let me tell you about credit. Credit is backed upon your assets. If you don't have assets, you have no credit. Okay? Most people think credit is this fictitious metaphysical thing that doesn't exist. Well, actually, it's backed upon assets, tangible goods, real life things that could be backed. And when I say don't get advice from people that are not already successful and rich and wealthy, it's because people that don't have wealth don't know what they're talking about because they haven't experienced yet. I'll give you one example. Okay, the biggest example of understanding who is wealthy and who is poor are people that have assets and people that don't. First of all, a car is not an asset, all right? A car is not an asset. It is a depreciating, well, the legal term is an asset, meaning in the tax term of asset means there's value that could be pulled from that. It has some value. But the reason why I label it as an asset, in the financial sense, not the tax sense, the financial sense, okay? A car is a liability because the note on the car, the interest you pay is a liability. The tax on that is a liability. And the fact that that value of that car does not appreciate in value makes it a liability. So here's the thing, here's a spectrum. This is the car and the value of that car is going down and your interest payment is going high when you have bad credit. And the longer you have to pay off that loan because you, little you, are just focused on the little monthly payment, you think that's actually building your credit, but you have no clue how credit works. So let's break down these costs over a 4-year period. Financing costs. If you're financing a Silverado, you're not only just paying for the sticker price, interest on auto loans can add a significant amount to your total cost. For example, if you finance a $40,000 Silverado at 4%, and that's assuming you have excellent credit. By the way, if you're trying to build your credit, that means you don't have excellent credit. People that have excellent credit are not really trying to build it. They're not in the building stage. So that would allude to you the level of financial savviness and credit expertise and level of their credit based upon the fact that they're building it. Like, you know, when you're growing as an adolescent, your brain's still growing, your body's still growing. But then when you pass puberty and into manhood, your body stops growing after the age of 25 in the sense that it has met its peak. So anyway, 4% interest rate over 4 years, you'll end up paying about $3,600 in interest alone. But that's not counting that depreciation. Vehicles depreciate over time, and some models can lose more than half of their value within the first few years. For a Silverado, you can expect it to depreciate for about 40% over 4 years. This means you bought it for $40,000. It would be only worth $24,000 after 4 years. Now, that's the reason why you're broke. Now let's look at the maintenance. Maintenance costs can add up. Over 4 years, you can expect to pay around $2,000 in routine maintenance. This includes things like oil changes, tire rotations, other services. And major repairs are needed. This cost could be significantly higher. So when you add up these costs, the total outlay for a Silverado over 4 years could be around $26,000, not including the initial purchase price. This is a significant amount of money that you could put towards other investments or savings. So if you're looking for long-term financial success, which is a prerequisite of building your credit, because like I said before, banks are smart. If they know you don't know how to handle money and they know that you just buy stuff that you don't need and lose money, they know they could take your money because the people that take your money know you could lose it in the first place. So again, building credit encompasses a lot more than just living in a trailer park and doing some credit sweeps to some of your trailer park friends and then acting like you know how to build credit, repair credit, and such other things. Okay, an auto loan is not going to build your credit as good as an actual credit card with an available balance and a low usage. Okay, These are the same people that are saying Bank of America is the worst bank. Are you a moron? Bank of America is one of the best banks to work with if you're rich and want to build your credit, because they have the best credit card around for rewards points. And if you want to build your credit, you need to build rewards points and have credit cards, multiple credit cards, not multiple notes on different cards that you technically and actually don't even own. The bank owns it. The bank owns it. The bank has a note. You're an asset to the bank. Your income is an asset to the bank, not the car. Assets are what appreciate in value over time. A car is only going to help your automotive score, but not really your FICO. It won't start helping your FICO until after it's paid off, because it counts as an installment loan and has a term. And so that's going to automatically affect your credit to debt ratio. And they're going to factor in your available credit. They're going to look at your credit cards. Does this guy have credit cards? Does he have banks? You have to have multiple banks and have multiple credit cards. Bank of America, Chase, there's a saying, don't put all your eggs in one basket, and it works well with credit as well. It's the same with credit. Don't put all your eggs in one basket. The FICO score built upon a diversity of things. And automotive installment loans, let me tell you what a real installment loan is. It's owning real estate, leveraging real estate. Why? Because real estate, you can leverage it, okay? You can borrow against it. You can't borrow against a car. You can't get a HELOC out of a car. There is no one doing that. I can tell you that. There's no one borrowing equity from a car unless you own it outright and then you use it as collateral. But how expensive can a car get? You're not driving a G-Wagon like the G-Wagon downstairs. That's a $300,000 vehicle right there, all right? That's more than people's homes. Now, with that being said, I want to just make it clear to you guys, do not get financial advice. Do not take financial advice from people still living in their grandparents' house, living in a trailer park, all right, that drive a Chevy Silverado that don't even have it paid off. A car is a depreciating asset due to the fact that its value goes down the more you drive it. I think there was a statistic. After the first year, the car already loses 20%. So basically, the money that you use to buy that vehicle, you've lost 20% of your money. You're a sucker. You're the loser. You're losing your money. You're not a winner. The real winners are taking their money and they're buying assets that appreciate in value, that make 20% return in 1 year, not losing 20%. So how smart do you think you are to finance some car and then lose 20 to 30% after your first year? And then you have to pay the interest on that money that you borrowed for that car in the first place back to the creditor, and then also taxes and other fees and wear and tear and maintenance on the car and gas and stuff like that. So you're losing money by trying to flex with the Chevy Silverado. Real people with money, they buy cars with cash. They don't need, people that have credit, they act as if they don't need credit. That's the real thing. That's, if you want to learn anything about credit, real people that have good credit, they don't use it like they need it. Okay, so getting a car to build your credit is not, that's just a poor man's way of justifying to get a brand new car. If you want to get a car, get a used car, okay? Get a deal, get a used car, and then just drive it from point A to point B, but don't lease it. You don't need to lease vehicles. You don't need to do that. That's fake living, okay? My cars I own outright. Don't make any payments on them whatsoever, okay? If you're going to make a payment on anything, let it be a mortgage, because at least a mortgage, you have tax benefits and you could leverage the asset. You now have control over the asset that appreciates in value, and you can make improvements to the home and you can get equity out later. That's how you build your credit, because banks understand equity. And if you have equity in a home, you get more credit because you can get what's called a HELOC, a home equity line of credit. But guess what? You're not going to get any credit from that HELOC, from that home, if you don't have credit cards. But if you have one car and a golf cart that you're currently paying on, that is going to affect your credit to debt ratio. Your installment loans are calculated in the underwriting process of getting a HELOC in the first place or getting mortgage real estate. And anything that changes like that is detrimental to getting approved for a loan. They want to make sure that they want to differentiate your assets to liabilities. So as far as credit is concerned, until that car is paid off, it's not technically even close to being an asset. So ladies and gentlemen, get financial advice from people that are already rich.